I'm Brian Hoops here, Midwest Market Solutions, bringing you our latest internet video series. It's Friday, September the 19th, 2014, and we're trying to make this a regular feature. So check back often to our website and get the up-to-date latest internet feeds from us. If you go to our YouTube account and find us, you can get the subscribe so you can see our YouTube videos directly sent to you or have a notification sent to you. Otherwise, just check out our website. We try and do these a couple times a month, bring you some educational type series and any marketing or trade ideas that we see becoming available. Before we get started, as we always do, let's talk about our disclaimer here. Of course, risk of loss in trading futures and options is substantial, and each investor and trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical test of strategies, of course, is not indicative of future results. Trading advice is based on information taken from trades and services and sources that we believe are reliable, and we do not guarantee information is accurate or complete, should not be relied upon as such, and trading advice reflects our good faith judgment at a specific time and is subject to change without notice. There is no guarantee that the advice we give will result in profitable trades. And of course, everything you hear here is copyright 2014 Midwest Market Solutions. All right, let's get into tonight's topic of conversation. Pull up a weekly corn chart here, and this chart comes courtesy of More Research Center. This is monthly corn going back to 1995-96, and I use my cursor here showing in 95 prices went from the low $2 mark all the way up to $5.50, $5.60. Pretty unprecedented time frame, as massive 1995 saw a drought year followed by China buying corn, give us a big rally in futures. But from that time frame, we were pretty much in a trading range. This red line here represents 320 in prices. This red line at the bottom is about 190, 195. And somewhere in here, we found some resistance points at about 280 a bushel. Resistance there. There was a couple times here where we bounced around, came close to it around the 270, 75 mark here a couple times in 2005 and 6 before prices blasted through it. Now you can see a couple times it came down to support, a couple times it came down to this 320 line. And of course, when it acts as resistance here in 2004, it acts as support after it's been breached. So you can see many times in 2007, 9, in 2009 again, in 2010, all act as support. And look where we're at as of today's close. We're about 330. So this line's kind of thick. The bar doesn't come quite down to 330. We closed at 331 and 3/4 today. So we're getting pretty close to this 320 support area. So I know we hear a lot of people talking about corn going under $3, and it's very possible. We did here in 2007 and 8. We did here a couple months that we got below it. But I don't look for us to spend a lot of time below 320. Very possible we're going to go down in this 280, 290 area and under this massive crop that we're looking to harvest. And then prices could bounce around, chop around like they did in here. But let's talk about a way we can profit or potentially profit from this down move yet. Now we're getting into harvest, and a lot of people we talk with, a lot of traders, producers alike, looking to add a little bit of profit or a little bit of premium to what they are making for the year, either on their hedges or cash sales or just out in their pockets as far as speculation. We'll look at options because of a couple different things. Now let's pull up our spreadsheet here, and a very similar spreadsheet to what we've used in the past. We've got we'll concentrate over here on this corn. And what we're going to do is enter a strike price, enter a premium for that option, and let's talk about that now. Corn is currently trading at 330, but what we want to concentrate on is using an out-of-the-money option because it's less costly. So we're going to enter in 310 as our strike price, and our premium, today's close, was about 4 cents. Now, what does this mean? Our cost is 4 cents. Our cost is $200. If you were to put a trade on where you bought corn puts puts mean to protect the downside. You have the right to be short corn at 310, and it's going to cost you $200 for a 5,000 bushel contract. Pretty small investment when you talk about it's not a small amount when you're buying groceries, but it is a small amount when you're talking investing in the commodities. The thing about buying options, and this is different than selling options, when you buy an option, the maximum loss is the cost of the option. So 4 cents a bushel times 5,000 bushels is $200. That is the most you can lose. Now, if corn goes below 320, we talked about support at around 280, maybe 285. If corn drops to 285, our option value goes from 4 cents to 25, and we've made a 21-cent profit. Our return on this is $1,050 profit. We bought it for 4 cents, $200. We sell it for 25 cents, which is $1,250, and we've made $1,050 on a $200 investment. That's our profit less commission. That's a return of about 525%, and you're going to do that before this option expires in November, so you're looking at 6 weeks. Not often do we get presented with opportunities to spend a little bit of money and make a lot. Sometimes it happens if you can get into call options into the summer when markets tend to rally. Here you're faced with an opportunity to buy a fairly inexpensive option, and if we do go down to support, you can have a nice profitable return on this. So that's what we're looking at in corn. We'll go back to that corn chart, monthly corn chart. You'd want to take your option off if we got around that 285 area, and as I said, very, very inexpensive way to play this corn market from the short side of things here going forward. All right, questions on that, contact me, and we'll get back in touch with you. We're going to look at weekly or monthly soybean charts now. This is our monthly soybean chart, and you can see we go back to this 95-96 time frame. We were under $6 and then rallied on strong demand up into this $9 mark. This is what became resistance. We fell back below here, and we carved out a trading range. Believe it or not, it was in the mid $4 range as a low from 1999 to 2002, with the high just in the $5 mark. We never got above $6 until we got in 2002, 2003, and then you can see this this bar here is right around 550. We found a nice support area with rally attempts exceeding our $9 up and above $10, and fell back into this this 550 area that held for some time in 2005, 2006. Now, certainly possible we've pulled back into this price area, but what have we done over the last 5 to 6, 7 years? Well, we've moved above major resistance in this 9 and this 1050 area. We've came back and found support either at $8 or at this $9 mark. You can see a lot of support here at $9. Even in late 2011, we came back into the mid-10s before rallying. Well, you can see as this chart shows, we've taken out major support here from 2013. We've taken out the lows from 2011. We're trading back to the lowest level since 2010 and likely to go down right into this $9 support area. Is it possible to go below that to 805? Certainly possible. We haven't found any type of a price bottom yet. So let's talk about how we can profit from that, similar to what we talked about in corn. If you want to do something in soybeans, we can buy a $9 put. We closed right around 9.57, I believe, in the corn or in the soybeans today. So you're buying an out of the money put, and a premium similar to corn. It's only 6 cents. So a $9 strike price put is worth 6 cents. Your maximum loss is $300. Again, 6 cents times 5,000 bushels is $300. When you buy this option, your maximum loss is the cost of the option, so $300. Now, what happens if we fall down to our support area? Well, you're buying a bean here right on support, right around this $9 mark. So let's just figure in futures go to $9. You have value of 0, and the profit is 6-cent loss. So you've lost $300. That's your maximum loss. Even if prices don't go below $9. If they stay at where they're at, it's $9. That's your maximum loss. But if we happen to go to, let's say, 8.50, now your 6-cent put turned into 50 cents, and you have a value of 44-cent profit. And now your $300 investment has turned into $2,500, and it has to do this by the expiration, which is about a month away, and your profit is $2,200 less the cost of the option. Big return on this potentially. So as I said, not often are we faced with the opportunity to spend a little to make a lot, but it does look like that potential is here, as the markets at this point have not heard about all the yield data and haven't found harvest lows type yet. They will probably come, normally they come around the first week of October, probably going to come middle of October when these options expire. That's normal harvest lows. So consider this as part of your investment portfolio. Very cheap, very inexpensive options, especially if you've been doing some futures contracts and on a little bit less risk. This way you could still benefit and have a lot of profit potential if the market drops into major support. All right, well, we'll sign off here, but again, remember, we don't guarantee results on these trades or any advice. You're better off talking to us directly and see if we can help you out in any way. Get your account set up if you don't have one. We can have full and discount brokerage services, and as well as newsletters and marketing advice. So check us out. You can reach me. My direct phone number, 417-501-5132. Of course, you're at our website watching this video. We have 3 offices around the country, so contact any of our brokers in those offices. Have a great time until a great day trading. Good luck trading until we talk again. This has been Brian Hoops for Midwest Market Solutions, and we'll talk to you again soon.